Welcome to the live economic and financial markets commentary. This live session will cover fundamental analysis in the week ahead, global coverage of current economic data, including major markets, news, analysis, and events, how to apply the best trading strategies prior to news being released and after. First, I'd like to start the session by giving you some information about me. My name is Ihab Jubail. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly in forex and commodities. And in recent years, I have also set up my own trading robots, signals, and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now let's start the session. The highly awaited U.S. non-farm payroll report disappointed the market with 142,000 new jobs when more than 200,000 were expected. The US dollar fell after the release of the lower than expected October non-farm payroll report, adding the fact that the upward revision to the August number that was anticipated turned out to be a downward change. The US Federal Reserve held rates in September, which made the dollar lose ground, but was quickly regained after policymakers still saw a rate hike before the end of the year. Employment, the strongest pillar of the US recovery, has reduced the possibility the Federal will act in the two remaining monetary policy meetings left this year. Some of the pressure the Federal was under to raise interest rates for the first time in a decade has eased for the American Central Bank. The pressure has shifted to other central banks that must step up their stimulus efforts to boost their economies. This week, the Reserve Bank of Australia and the Bank of Japan are expected to add to their easing policies to spark growth in local economies. The Bank of England will also host their rate-setting policy meeting, but in a similar situation as that of the Federal, the British economy has cooled down along with the prospect of a higher interest rate in the UK in the near term. The Federal will release its minutes from the September FOMC later this week. But after this Friday's disappointing non-farm payroll, it will be hard to take them in context as the outlook that produced them has changed. The Reserve Bank of Australia is expected to hold rates on its meeting this week. They will hold rates. Central Bank last cut rates in May to a record low 2% rate to boost the economy and offset the negative effects of the fall in commodity prices and in China slowdown. It was the second rate cut of the year for the RBA, but after the Federal lack of action on the rate hike front, the pressure is now on the other central banks to step up their monetary policy in the other direction. The disappointing US employment numbers will probably have some weight in the RBA's statement, but too soon to tell if they will force Governor Glenn Stevens to cut rates in this week's meeting. The fact remains that the RBA will remain under pressure as the U.S. Federal's interest rate hike timetable could be pushed well into 2016. This could result in a rate cut to the Australian benchmark rate before the end of the year and a lower Australian despite the risks to an overheating housing market there. European inflation turned negative again in September, a few days ahead of the American jobs report. The market had begun to pile pressure on the European Central Bank after the US Federal Reserve had decided to hold the American benchmark interest rate. After a disappointing non-farm payroll report, the probability of a hike before the end of the year has been reduced and putting the load on the ECB to add to its quantitative easing program launched earlier this year. Note also on Tuesday, October 6, ECB President Mario Draghi will speak at Art on Site event in Frankfurt, Germany, so you can watch him. In Japan, Governor Kuroda remains optimistic, but the market expects the Japanese central bank to increase its stimulus program this week. The Bank of England was also optimistic about the UK economy at this time last year, but its head economists start to see the economic clouds signaling the coming storm. At one point, the UK economy was enjoying a healthy growth that put it well ahead of even the US and the first developed economy that would raise rates. The commodity prices and overall global growth forecast downgrade has pushed that back into next year. The Bank of England will publish its rate statement, and in an effort to increase transparency, it will also publish the minutes from the Monetary Policy Committee meeting. The disappointing US jobs report validates the decision by the Federal Reserve to hold rates unchanged. The problem with the Federal giving so much weight to the employment component was that it cannot keep rising forever. There is a point where gains will be marginal and, as seen these days, some setbacks. The Federal was right to base most of rate rise on employment, but it might have missed a window to hike while still having the support of a strong job data. Overall, the Federal does not want to lose more credibility, and it has chosen to be on the side of patience than to backtrack on a commitment if economic conditions deteriorate. This week we will watch these events in London time. We had already two events today and tomorrow, 6th of October at 4:30 London time AM, Australian RBA interest rate, and at 12 PM London time, 8th of October, Thursday, UK Bank of England interest rate, and then Friday, 9th of October, 1:30 PM Canada employment change. I will talk in more details about this news. Australia RBA interest rate decision will be released on October 6th at 4:30 AM London time. It's expected in Australia to keep rates unchanged, especially considering recent news out of both China and US, especially the non-farm payroll report last week, have shown that there are no danger keeping policy the same. It's forecasted at 2%, previously the same 2%. How to trade this news? Our trade plan will be if RBA decides to cut interest rate by 25 basis points, we will sell the Australian dollar. If RBA decides to keep high rates back to 2.25%, we will buy Australian dollar as market is expecting an unchanged number. Ultimately, we are a bit bearish on the Australian dollar as RBA has opened the door for rate cuts. And considering recent drop in crude prices, RBA definitely have room for rate cuts. As usual, if we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment downwards. You can see 1 minute chart of Australian dollar last release, September release, during and after the news. It was very simple and easy trade. We did not get our deviation number, so we just followed the trend. We could make fall or down option in this news release. And after the first reaction to the news release, the market just kept following the trend. Bank of England interest rate will be released on October 8th at 12 p.m. London time. Bank of England interest rate decision has been interesting for the last few releases because Bank of England decided to release vote counts and policy summary along with the rate decision. This could add some volatility in the market, especially considering the current status of the dollar. Bank of England interest rate forecasted at 0.5%, previously also 0.5%, no change. APT, or asset purchasing target, forecasted at 375 billions, previously the same, 375 billions. So the plan to trade this release is if, and it's unlikely, Bank of England hikes rate to 0.75%, we will buy the pound immediately or place up trade. And because of the level of this surprise, I think we will see a strong trend change for the pound in the next few weeks. For sure, it will change upwards. We will have new trends upwards. On the other hand, if we get a surprise increase to 400 billions or more in the APT or better, it would send a bearish signal to the market and we should sell the pound in the short term. However, further stimulus is likely to help the pound in the long term. So if you miss the original sell, if they increase the APT to 400 billions or more, and you missed the sell entry or down trade or option, I would suggest to buy the pound instead at support. There is also possibility for the third scenario for this event, Bank of England cutting rates to 0.25%, and if that is the case, it should be sell on the pound, and we will see the pound keep weakening even more. If we don't get the deviation number, I expect the market to follow the pre-release market condition and sentiment downwards, as we can see, as this is the daily chart of the pound dollar. There is a strong trend downwards. In Canada, employment change will be released on October 9 at 1:30 p.m. London time. We will be getting the Canadian employment change release number on Friday, but since it is the only high impact release during this Friday, we should see plenty of actions and volatility. It's forecasted at 0, previously 12,000. And the Canadian unemployment rate forecasted at 7%, previously the same 7%. And how to trade this news? I will be looking for a minimum deviation of around 25%. So if we get a positive 25,000, of release, we should see demand for the Canadian dollar. Therefore, we should buy the Canadian dollar against weaker currencies at the time. However, if we get a negative deviation, minus 25,000 or worse, we should see some weakness in the Canadian dollar, and that will be our chance to sell the Canadian dollar against stronger currencies at that time. So we'll buy Canadian dollar at 25,000 and sell it at minus 25,000. If we don't get the deviation number, I expect the market to follow the pre-release trend, and according to the recent movements of the market, like this chart of Euro Canadian dollar 1 hour, it would move downwards. So we will just follow it if we don't get our deviation number. So then I'd like to thank you for attending today's webinar. We will hold following webinar next Monday. Goodbye and see you next time.